for coming. Hi, everybody. Thanks so much for being here today. We're going to get started in just a few minutes. We're just going to wait for folks to come from the waiting room. So give us a minute or two, and then we'll get started. Hi, thank you all for joining us this morning. Super excited to have you here. We're going to get started in just a minute once everybody comes in from the waiting room. Okay, I think we have a quorum. Let's get started. We have so much to talk about today. I want to be respectful of everybody's time. Welcome. Thank you so much for joining us. I'm really excited to be moderating this conversation about what will it take to expand access to homeownership, especially for Black, Latino, and other underrepresented communities. This isn't an easy question to tackle. Although the housing market has softened in the last year or so, house prices in the US have increased by nearly 50% just since 2020, and incomes have not followed suit. Higher interest rates, coupled with rising insurance costs, or in some cases, the inability to secure insurance at all, have made buying a home even less affordable. Where people are moving to is also changing, driven by changes in work due to the pandemic in some places, and gentrification and the need to move further out to find an affordable place to buy for others. These broader challenges are unfolding within a housing market that remains deeply segregated by race and ethnicity. In 2023, only 46% of Black households and 50% of Latino households own their homes, compared to 74% of non-Hispanic white households. This gap is rooted not just in historical discrimination, but also in ongoing patterns of lending disparities and exclusionary zoning policies. It's indicative of how far we still need to go that the Black-white homeownership gap today is larger than in 1960, before the Fair Housing Act was passed. And while access to homeownership is a national issue, it's exacerbated here in California. Homeownership in California is increasingly out of reach relative to the rest of the country. In 2021, the share of adults who own their home in California was just 44%, more than 15 percentage points lower than the rest of the United States. And our research shows that it's especially difficult for younger households to buy a home. Among Californians aged 35 to 45, which is sort of the prime home buying age in most places, less than 40% are homeowners, a near 10-point drop in just 2 decades. Against this backdrop, our webinar is bringing together leading voices to discuss solutions, from state-level efforts like the Dream for All program to innovative approaches driven by local practitioners. I'm really excited to dig into these issues with our panelists, but before I introduce them, I have a few housekeeping items to go over. First, I would like to thank our funders at the Wells Fargo Foundation for their support of the Turner Center's research on increasing access to homeownership. Thank you. Second, for all of you wonderful people who have joined us on this webinar, if you have a question for our speakers, please put it in the Q&A section below. You'll find that tab at the bottom of your Zoom screen. We'll spend some time at the end of the panel answering audience questions. And finally, if you want to share this conversation with others, it will be recorded and available on Turner Center's website. Now it is my absolute pleasure to introduce our panelists. I'm joined today by a terrific panel of experts. First, Ellen Martin is the Director of Homeownership at the California Housing Finance Agency, or CalHFA for short. I've learned so much from Ellen over the years, and we're really lucky to have her leadership in Sacramento on this issue. Thanks so much for joining us. Next, Lorena Limon is the CEO of the Casita Coalition, where she leads efforts to address California's housing crisis through policy advocacy and community engagement. Lorena also sits on the board of CalHFA, and we're super lucky to have her as one of our Turner Center Fellows. We're also joined by Dustin Swander, who is a PhD candidate in economics at UC Berkeley. I've had the pleasure of working with Dustin over the last year or so on a collaborative project with Ellen to better understand the market for first-time home buyers in California. And he's going to share a little bit of his preliminary findings with us today. And finally, I'm absolutely delighted to share the panel with my colleague, Cara Murray-Badal. Cara is the director of the Housing Venture Lab, a program at Turner Labs, which is an independent nonprofit that we founded in 2020. For the past 4 years, Cara has been working with innovators across the country to address housing challenges, including efforts to expand homeownership among underrepresented communities. So Cara, I'm actually going to start with you. Could you share a little bit about what the Housing Venture Lab is all about and its goals?
Yeah, I always say I have the coolest job in the world. I'm the luckiest girl in the world. And my work really is so Turner Center obviously is doing this amazing housing affordability and policy research. And we were getting so much inbound from organizations that were like, we're trying to do this. Like you're showing us these issues and we are working on those issues. There's not really a lot of support in the system for those organizations. And so that's how Turner Labs was born. The Housing Venture Lab, we sometimes say, birthed its mother because Turner Labs is now bigger than just a Housing Venture Lab. But essentially, it's like with the idea that you can throw a lot of money at housing and housing development, and it can go not very far at all. Like you could spend $1 billion in a flash and help, a small number of families. And for those families, that money would be incredible. But the idea of the Housing Venture Lab is that we do small seed grants, targeted seed grants to the organizations that we think are doing the most innovative work in housing affordability right now, and we see if we can make it grow and we see if we can scale it. We throw in a lot of investment and startup support and community help from all of these different realms of the housing ecosystem to see if we can farm these ideas up so that we can make catalytic change to actually change the housing ecosystem. So pushing ideas forward that hopefully will make big differences with a smaller investment.
Amazing, thank you. So I think as Cara described, she's really focused on local innovation, scaling that innovation. Ellen, you've been leading state efforts to particular overcome down payment barriers to homeownership, and with a real focus on first-time and first-generation home buyers. Could you tell us a little bit about this work? And specifically, I'd love for you to share with our webinar audience a little bit more about the Dream for All program.
Sure, absolutely. So the California Housing Finance Agency provides down payment assistance that's combined with access to first mortgage financing, generally for first-time home buyers. Our flagship program is known as My Home, and that offers up to 3.5% down payment and or closing cost assistance for eligible home buyers. The Dream for All program is an innovation that we first launched back in 2023, where we're providing much more generous down payment assistance. So with the Dream for All program, we're offering up to 20% down payment or closing cost assistance that comes in the form of a shared appreciation loan. So that means that the borrower really has no payments or no interest due until they sell, or in some cases refinance their home. And then they pay us back the original amount that they borrowed from us for down payment and or closing cost assistance, and also pay us a commensurate share of the appreciation in the value of their home. So put a slightly different way, if they borrow 20% from us, then when they sell that home, they would repay that original amount that they borrowed plus 20% of any of the appreciation that they've seen in the value of their home. So I think what we've seen with the Dream for All program, it's been incredibly insightful, and I think has really made a very meaningful impact. What we see is with this generous down payment assistance, we are able to really help folks get access to an incredibly challenging housing market. The eligibility for the program is low and moderate income first-time home buyers. And then as Carolina mentioned, there is also an element of first-generation homeownership. So one borrower on the loan has to be identified as a first-generation homeowner. And in our case, and we can go into sort of the whys and wherefores of this, but in our case, a first-generation homebuyer is defined as one whose parents do not currently or did not at the time of their death own a home. So as I said, I think that this program has really helped us make great strides in terms of leveling the playing field and really helping these borrowers that might not otherwise be able to access home ownership get into this extremely challenging market.
Thank you. And we're already seeing tons of questions pop up, but there were a couple of clarification. One is just, how does Cal HFA define first-time home buyer?
A first-time home buyer is a buyer who has not had an ownership interest in their principal residence for the last 3 years, nor have they lived in a home owned by their spouse over that same time period.
Great. And I know that you are in the midst, maybe just wrapping out up round 2 of the program. Do you have any early results in terms of who you've been able to help?
Yes, we've been very pleased with the outcomes of phase 2 of the program. I can talk a little bit more. So phase 1 went out extremely quickly. It was vastly oversubscribed, and we committed about $300 million in down payment assistance over the course of just 11 days. So for the second program, we made some really major changes in how we delivered the loan product so that we could slow things down and really make sure that we're accessing those homeowners that might currently be on the sidelines, and with the assistance of this program might reconsider whether or not homeownership is actually viable for them. So the primary thing that we did is we instituted a pre-registration and randomized selection process, which also allowed us to implement geographic set-asides and the first generation eligibility criteria that I mentioned earlier. So folks that were successful in the randomized selection process then had up to 6 months to purchase a home. If folks did not use their awards, their conditional awards, then we moved on to the next borrower on the wait list specific to that region. So we had over 18,000 applicants to the pre-registration system for approximately 2,300 conditional awards and anticipated Dream for All loans that we will be making for this round. So far, we've had just over about 2,000 borrowers use their conditional award in order to get into a purchase contract and make a reservation to in Cal HFA system to purchase their first home. So we're really excited about that. The average loan amount is coming in at about $115,000. The average home sales price is coming in at about $600,000. So that is exactly what we expected to see given the institution of geographic set-asides and the shift of loans from kind of the central, more affordable areas of California over to the coastal areas as well. Over 75% of our borrowers that have currently used their reservation to take out a Dream for All loan self-identify as belonging to a community of color. We maintained our performance in the AAPI and Latino communities from phase 1. So in phase 1, we overperformed in the Latino and AAPI communities. One primary focus of this round of the program was to make sure that we built on our performance in the Black and African American community. We did find with the nature of this loan product that we needed the time associated with the pre-registration process to really build trust in order to reassure folks that this loan was was a good loan with disclosed terms that they felt comfortable partnering with the government in this home buying process. So we're happy to report that in this round of the program, we have more than doubled the uptake of the program in the Black and African American community. We're seeing that uptake on par with the composition of households and well outperforming the composition of current homeowners in California. So overall, we're very pleased with our round 2 outcomes. As we move forward, we will be looking at ways to streamline our waitlist efficiency and really make sure that we move through that waitlist assertively so that we can make sure that everybody who is ready and able to benefit from the Dream for All program is able to do so.
Great, thank you. And we'll come back with some more questions in a minute, but I want to turn to Dustin. So you've really been working to figure out like who is on the sidelines, right? Ellen's saying that they really want to improve program and processes to make sure that everybody who is eligible and ready can access the program within the constraints of how much funding it has. But you've been trying to estimate that. Can you tell us a little bit about what you've been doing and what you're finding?
Thanks, Carolina. Yeah, so I've been tackling this question using a unique data set that's maintained by the California Policy Lab. It's called the University of California Consumer Credit Panel. So what's unique about these data is that they cover the consumer borrowing activity of everyone who's lived in the state of California at some point between 2004 and today. So the data allow us to see whether people have previously taken out home loans, how good their credit's looking, how much debt they're carrying, and so on and so forth. So one key takeaway from my work with these data is that there are lots of potential first-time homebuyers in the state of California. I estimate that there are between 1.6 and 4.2 million. And of those, I think as many as 1.1 to 3.2 million could be first-generation homebuyers who could use down payment assistance. So these are renters who are aged 25 to 55, which is kind of an expansive but relevant, I think, peak first-time home buying age range in California, who we estimate earn enough to afford a monthly mortgage payment, but may not have enough cash on hand to afford a down payment. Now, why would that be? So it turns out that the typical sale price for a California home these days is around $750,000. 20% down payment on a $750,000 house is $150,000. Even a 5% down payment on that house is $38,000. So many households just don't have that kind of money available, even some middle and even upper middle income households in high cost areas.
Great, thank you. And we're going to talk a little bit more about sort of where these buyers might be in a second, but I want to give Narena a chance to give us an introduction to the work that she's been doing at Casita Coalition and some of her early reflections on this question of like, what should we be doing to increase access to to homeownership?
Yeah. Thank you, Carolina. First of all, so excited to be on this panel with all of you. I love geeking out about this topic with the folks in this.
Oh, we don't at all.
on my spare time. So this is a lot of fun for me. So I have been working on the issue of homeownership for a while now, from my time at the Consumer Financial Protection Bureau to my time at the National Association of Hispanic Real Estate Professionals. And the more that I've worked on this issue, the more I realize that the issue of housing supply is a critical component to our ability to close the homeownership gaps. And I want to go back real quick to how you started this conversation, Carolina, and the incredible need for us to do more on this topic, especially in the state of California. If we look at the country, California has the second lowest homeownership rate in the country. And when you think about that in the perspective of what that means for bridging the racial wealth gap, California is one of the most diverse states in the entire country. We have the plurality of California is the Latino community. And so when you have such low homeownership rates, it's really important to understand why or where it's coming from, because if you think about where homeownership growth should be coming from, it should be coming from communities of color, because communities of color are younger. And if you look, for example, at the Latino community, which is a community that I've studied a lot in my past, the median age is 31. That is supposed to be the prime home buying years of an individual. It's historically been so. It's a little bit older for the African American community, but it's still, communities of color are younger than the non-Hispanic white population. And so that is where homeownership growth should be coming from. So if we're thinking about increasing the homeownership rate for the state of California, it undoubtedly will probably come from that community. So the conditions have to be in place so that those communities can buy. And it's also imperative for our property taxes. It's imperative for our continuum of housing and for our economic mobility to exist within the state of California. There are too many renters that should probably be homeowners right now, but there isn't that starter home supply available to them. And I mean, we have folks that are living in affordable housing developments that have reached an 140% AMI that should be homeowners, but there isn't that pipeline for them to be able to purchase a home, even just from a price point. And so this is what we've been doing. So Casita Coalition is an organization that is very proud, first, of a couple of things on this topic. To have been part of leading the California's EDU revolution. This is one of the, we feel proud to say this is a very successful housing policy in California. At the same time, we've also just merged with California Community Builders, who was part of the team that worked on the California Dream for All program, which I want to commend Ellen and her team for the amazing job at iterating that program to make it better and better, to serve more and more people in a more effective way. And I love seeing it evolve, and I'm excited for it to continue evolving. But coming back to the Casita Coalition and really taking the wins from our ADU successes in California, we look at other states and what they were doing when it came to providing starter homes for their communities. And one of the more innovative and strategic and I think successful strategies that we've seen around the country is this concept of ADU condos. So we saw that in Portland, we saw that in Seattle, we saw that in Austin, that, in those states, there was never a prohibition for ADUs to be converted into condos. That did exist in California. And so what we did at the Casita Coalition through AB 1033 is that we removed the prohibition for ADUs to be converted into condos. And now cities across the state are opting in. We've seen cities like San Jose, Berkeley, Santa Monica, San Diego, Santa Cruz, West Hollywood, and San Francisco opt in to this model. And we think that what we see in other cities and states is that ADU condos typically sell for 40 to 60% of the price of detached homes. We think that this could be the most critical supply of starter homes in the state of California if we figure this out and if we reach scale. And it's a lot simpler than you think. I think there's a lot of confusion in terms of how this all works. But all it is like, let's just simplify it. There's a primary home, there's an ADU in the back. Then you create a simple HOA between the primary home and the ADU in the back. So now the primary home and the ADU become condos. So it is a very simple condo lot regime that is established. You decide who is going to pay for what in terms of the carrying of the land. And then each home is sold separately, just like any other condo. So we're very excited about this. We're doing a lot of work around implementation and education throughout the state. We hope to see more and more cities adopt. We saw the first ADU condo happen in San Jose, actually the day of our convening, which was really exciting. So we expect to see more and more, and as we all work together on the critical implementation work, to see this be a critical funnel of starter home supply.
Great, thank you. I'm just going to ask a quick question that's also in the chat. Ellen, if we are able to convert more of these ADUs to condos, would that allow people to use subsequent rounds of Dream for All or other Cal HFA financing products on those units?
That's a fantastic question. I'm going to answer it as a generality. CalHFA's down payment assistance programs are generally paired with an FHA, USDA, VA, or Fannie Mae conventional loan. So in the case of Dream for All, only Fannie Mae allows the pairing of a shared appreciation loan with their product. But generally speaking, so long as those guarantors and insurers permit purchase of those units, then you would also be able to utilize our assistance with it. So I don't foresee any challenges associated with the condoized ADUs. And I'm actually incredibly excited to see that program start to scale.
Awesome, thank you. So I want to stay on this issue of supply for just another minute or so, because I think it's critical, particularly when we think about just how much most typical homes in California cost, but also in other parts of the country. We need more lower cost starter homes. I think we also have to think about where those low cost starter homes are. Dustin, you found some interesting things about sort of the geography of where we see a lot of these eligible people sitting on the sidelines. Can you share a little bit about what you found?
Yes, thanks again, Carolina. So it turns out that potential first-time homebuyers make up the largest share of the consumer credit market in coastal areas primarily. So Bay Area, LA County, Orange County, and San Diego County. Of course, these are relatively high-income areas of the state, but they're also really high-cost areas, and they have lots of economic inequality. And we know from other research that these are also areas where the transition from renting to home ownership is particularly slow, even among older households. On the other hand, in the Central Valley and rural areas, we saw higher home ownership rates among people who, based on their credit history and income statistics, we think could qualify for and afford an FHA mortgage. And so that translated into smaller potential first-time homebuyer markets in these inland areas. So I think these geographic patterns are consistent with the idea that supply is not as stringent as of a constraint when we look inland, but they seem to suggest that we could build more housing, especially that first-time homebuyers can afford in coastal areas.
Right, thank you. Kara, I want to turn to you because I think some of the innovators that you're working with, some of them are trying to figure out how to make state policies like SB 9, which allows for lot splits, more effective. But you're also working deeply in urban neighborhoods where people are trying to establish homeownership opportunities in historically communities of color, prevent displacement. Can you talk a little bit about what innovations you're seeing there and maybe some of the tensions in this work?
Yeah, this is like, okay, I'm like, this is where I'm like, oh, here we go.
I knew you were waiting for me to ask you this.
I mean, I think it's like, so we can, like, if we zoom out, right? Like you started this call again by talking about redlining and the ways that communities were segregated and separated. And along with that, we did something, I was gonna say some words that aren't the right words. So we did something a little bit silly in that, like, we zoned for all the single family neighborhoods and made it so that only a certain amount of people could live there. But in that same process, we did not utilize our land well. So we've been talking about supply. We have these like sprawls of single family homes where it's just not dense enough. And when as population is increasing, as people are moving into cities, it's just not enough housing for those people. And like, yes, that has deep roots in discrimination and has had deep impact on specifically, largely the Latino community, definitely the African American community. It's been a problem for years and years and years because all of that money from equity has just been lost to those communities. That was bad for a specific community, but now we're in this place where, like, I am a millennial and I identify with that very strongly, and all of my millennial friends, Black, Latino, Asian, white, cannot buy a home, and it is because of this history. And so now when we're thinking about remediation, and I'm looking at all of these wonderful companies, I'm thinking about the trade-offs that we're making, which is that, like, we want to densify in these neighborhoods and communities, and we want to support Black and brown home ownership, but it doesn't necessarily look the way that it might have looked in the year 1960 because the supply is so scarce. And so I think some of the organizations that we've seen that are doing really amazing things and trying to figure out this trade-off, Frolic, for example, is based out of Seattle. in Seattle, there are neighborhoods that are gentrifying where the property values are going way, way up. And so all of these low income Black and brown families are not able to stay in their homes. And so what they're doing is they're converting single family lots into co-ops with 5 or 6 lots where the homeowner gets to stay on the land and use their equity to build several other lots. And then it has like a $10,000 to $30,000 down payment. So it allows more low income folks to be able to stay in that neighborhood that otherwise is gentrifying. Then you have like the problem that we've talked about earlier of credit scores and credit worthiness, and the fact that like African Americans who and Latino folks and just low income folks in general who could afford a home, probably who are paying rent consistently, just don't have a credit history. And so Asusu, which is our largest company, all that they do, they're like their main innovation, which is crazy that this even needs to be an innovation, is that when you pay rent, it goes towards your credit score. It's like if you could pay rent, you could probably pay a mortgage. So like that feels like very intuitive. And then a couple of our organizations, Project Own and Credivolve, are working specifically with people who are denied, who look generally ready to buy a home but are denied based on their credit score, and doing intensive HUD counseling and trying to figure out the HUD counseling process and the mortgage counseling process. And I bet that is like low hanging fruit. It's like these are people who basically could have a home, their credit score is just bad. But like sometimes we pick the low hanging fruit. Sometimes we're like, yeah, those people when we can skim off the top really easily and all it takes is a year of good credit counseling, like amazing. And then on the last issue of what we do for people who want to be homeowners, who are maybe not making the incomes that it takes. Grounded Solutions Network, who's in our current cohort, and also Jubilee are both working on this issue. One uses like a CLT model community land trust model.
I was just about to say, what's the CLT?
which is in some ways similar to what we're talking about with Cali GFA, but it uses a nonprofit that owns the land. So you separate the land from the home, and that land stays affordable in perpetuity. Now, the interesting thing about that, right, is that you don't necessarily get the same amount of equity that you would get from your own home ownership, but you do get to live in like a neighborhood that you otherwise wouldn't get to live in. And that's like, that's about, okay, so what is a house? Is it an asset, or is it a community value? Is it a family value? Because for those families, they get to live in a neighborhood that they otherwise wouldn't have been able to, that has, a great school and good produce and all of those things, and then pays dividends for future generations. So we lose some of the equity, but we gain the community value. And Jubilee is doing something very similar. It's another one of our organizations, but they're doing it with a bank investment where the bank holds the land. So they can scale much more quickly, but you lose the community aspect. And so there's always trade-offs as we're trying to remediate these, historical things that are affecting all of us now.
Thank you. Noreen, it looks like you are going to jump in. I know that you feel passionate about this topic too.
No, I mean, I was going to just in terms of like what we've learned, right? What are some of the various levers? Kara alluded to some of the innovations that we've seen out in the market. But one of the things that Casita Coalition has been looking at is what are different states doing? And we know that we have a very severe homeownership crisis in California. So what do we do to spur the development of starter homes through zoning? And so what we've been studying different states, and obviously I talked already about the concept of ADU condos, that, if you look at Austin, for example, if you go to the city of Austin, they no longer even call them ADUs. They're just, they're called AB units, or they're 2 to 3 units per lot. And the way they look is it's essentially 2 homes. I saw a lot of 2 homes when I was there. It's the primary home in the front. There's a home in the back. There's a driveway that goes to the back, and you see this all over the neighborhood. And it becomes a way to double the amount of homes in a neighborhood, still maintaining that neighborhood scale. And so that's been, what we're trying to do in California. Is probably our most palpable option in California. But there's other levers that we've seen around the country that I think are really interesting. So we have the townhome development, or the burst of townhome developments that's happened in Houston. And we wonder why. We saw that in 1998, Houston reduced its minimum lot size from 5,000 square feet to 3,500 square feet. It was actually 1,400 square feet in some of the areas. And that resulted in 80,000 plus townhomes and small lot homes built. So what happened is when you reduce the lot sizes, homes became taller and thinner. And actually the square footage of homes were actually larger than they were had they been single family homes. But that was a very successful strategy that I think we've been looking at around the country. Different states have been looking at to emulate because it's been so successful in Houston. And actually, recently this year, Texas, 18 of the largest cities capped their minimum lot size to 3,000. But you look at California, for example, it has one of the second smallest square footage, lot sizes in the country. I think it's so Texas now is like about 9,450. But our land is so expensive compared to some of these other areas. But this reduction in lot size has been successful in incentivizing, aligning incentives with developers, that it makes a lot more sense for them to build a bunch of townhomes in a similar lot than it does to build a large single family home. So we saw that. We also, there's another policy in Nashville that we think is really interesting. It's called the horizontal property regime. This is an old law that was revived. We're now seeing that over like 20,000 homes were built since 2010. I think Nashville is the second largest in for sale development in the country right now. But the way that this horizontal property regime works is that they develop a townhome partnership. So for example, everybody that lives in that compound with different homes, then they're able to all just own the land together in a way. It kind of gets away, it gets around some of the HOA rules. It's in terms of procedural simplicity, it's a really interesting way of combining the site plan flexibility of a condo with the conventional financing of a fee simple home, while omitting the usual organizational complexities of an HOA. So it's a really interesting model that we've seen that could work in California. But that's what we're looking at right now is like, what are the kind of the zoning levers that could be pulled that we're seeing successfully be implemented around the country.
Great examples, really interesting. Ellen, I know that you run a demand side program, right? You don't do the supply side, but every time we talk, you're like, there's got to be innovation here. There's got to be a connection between the demand side and the supply side interventions. How have you been thinking about this sort of connection between the two?
Yeah, it's so critical to the work that we do. And I've said it once, I've said it a million times. As a demand side incentive program, the value of our program really is dependent on the supply of homes that low and moderate income Californians throughout California can afford to buy, right? So without that supply, we really can't make a major sustaining impact on homeownership, right? I do think that we also should recognize the role of federal policies and federal policy levers that we need to think about. One of the great advantages and constraints of CalHFA's programs is the fact that we leverage these capital markets that are backed by the GSEs, FHA, VA, USDA, right? So we are able to come in with a relatively small amount of down payment assistance and help plug that really critical upfront gap, help plug the required down payment in order to access an FHA or conventional loan. And then we rely on these private, essentially these private capital markets to fund the entirety of the first mortgage, right? So what we really do have to think about is also the role that the federal government and the rules surrounding first mortgage financing might constrain entry-level housing. One thing that comes immediately to mind is Fannie Mae rules on condo projects that provide, barriers to accessing condo financing that I think we really need to talk about. And so we need to think about that. But overall, I really, I think that supply has to be paramount in how we talk about this problem. And I don't think it is completely off the table to think about how you might use down payment assistance to sort of flip it on its head and turn it into a supply catalyst. And so that's the kind of thing that we're always looking for, opportunities to identify ways in which that demand side incentive can really help to propel the supply side of the equation as well. So stay tuned for more on that.
Thank you. Dustin, Cara was talking about some of the companies that or organizations that she's working with to try and overcome credit scoring constraints. I think you've done a little bit of work to look and see sort of the impact of those credit scores and our current ways of scoring people's ability to repay on that sort of prospective home buyer market. Can you share a little bit what you found there? Like, how important is that anyway?
Sure, yeah. So I thought it was really interesting to hear Cara talk about these companies working in this space. It's really consistent with what kind of we've seen in the credit bureau data that we've been working with. So, to preface all of this, we know that unequal access to credit and income inequality along racial and ethnic lines are really profound social problems that reflect historical and contemporary injustice in housing markets and beyond. And so, kind of unsurprisingly in the data, we find that credit scores are a really stark barrier when it comes to Black homeownership. Income is also a really important barrier actually across the board in California. So in fact, of the folks whose credit scores I think would enable them to qualify for a mortgage, only about a quarter of them we think could afford a monthly mortgage payment. But of course, these income barriers also really hit hard along racial and ethnic lines, particularly for Black and Hispanic homeowners, and really especially when we look at the high cost coastal areas.
Great, thank you. So I'm going to pose this next question to all of you, and then I'm going to turn to some of the other questions in the audience Q&A. But Ellen, you've talked a little bit about federal policy levers. Norena, you've talked a little bit about other models in other places. Cara, you've talked about these groups trying to sort of overcome actually policy constraints, right? And ways of doing things that we're doing now. Where do you think the most important policy levers are? If we really want to change these systems, if we really want to make sure that we're providing access to people who are ready and able to buy a home, like what are the big policy levers or potential wins? And I'll let you guys decide who wants to go first.
So
Yeah, go for it.
okay, I'm happy to start, and then Cara, I'll kick it over to you. So again, just to reiterate, I think we have to think about the ecosystem as a whole, and make sure that not only are we looking at the specific policy levers that Norena and Cara have talked about, but also be looking at the financing ecosystem. So I love to hear about these ideas. I love to hear about what's coming sort of down the pike from folks like Cara and Norena, because then we can look at the financing ecosystem and see if there are any existing barriers. A great example of this is knowing how much priority really the state of California and the entire industry is placing on offsite construction and factory built housing. CalHFA identified a potential challenge in accessing conventional financing for those types of products. So we developed a down payment assistance program known as My Access that is partly intended to plug that existing gap on obtaining conventional financing for factory built homes. So I think that's a key factor that, at least from where I sit, we have to know what are the emerging concepts, the emerging trends, what's about to take off, what do we think is going to take off, and what are the financing challenges that folks might face that would really prevent those ideas from scaling once they come to market.
Yeah, I think kind of like in a similar vein, it's like it's not so much that I have like a policy in mind where I'm like, if this policy were implemented, we would just fix everything. And you talked about SB9 in the last question, which I realized I did not answer. And like we have a company called Build Casa, and what they do is they try to capitalize on SB9. You can sell a piece of your property off and turn it into new development, but like unless there is a mechanism to make that actually happen, like the process under which it happens is really difficult. And like if you talk to developers who've tried to do it, they're like, oh, there's so many things you have to do. And so Build Casa is really amazing because they really understand the process by which by which you have to do these lot splits. They know how to find the families and the lots that make the most sense, and then they like kind of have plugged the gap and are starting to develop in that space. But I think it's more often that there's really thoughtful policy, or like policy that is in reaction to things that like discrimination or problems in the system, but there's not necessarily like anyone in the market to then capitalize and support that. And so I think the thing that I think about a lot is like policy needing to be flexible, like needing to have good research, like research at Turner, if I may toot my own community horn over here, like that is looking at what happens when a law is passed, and then what is the remediation or what are the systems changes that need to happen around that law in order to make it useful to the population.
Yeah, I think that's a really good point. And I think, Norena, you've really had experience with this with the ADUs, and it's even what you were sort of talking about, right? Like we've had to bite at that ADU apple lots and lots of times to get it from being just like, either your man cave or grandma's backyard unit to really adding to the supply for people to move into as real homes.
Yeah, absolutely. I mean, it's iterative process. It's a very urgent crisis. But unfortunately, what we've seen is that it takes iteration. It takes trying different things. I would say that, I mean, I'm a big believer that figuring out the supply piece is going to be uh, probably the most important in creating impact around home ownership. Um, and if we're going to solve this issue, we also have if we're going to go with the ADU condos and all of that, we still need to solve for the fact that we don't have reliable ADU financing. And that is something that we've been working very closely with coalition partners around the country. As there is some progress that's being made at the federal level right now that that could change that, but there is a lot more innovation that needs to happen, hopefully within the private sector, within the housing finance agencies, within Fannie and Freddie, to ensure that we are creating that financing, because like Dustin said, incomes have not kept up with the cost of housing. But in a weird way, if you have an ADU in the back, you do raise an income, because that is additional rental income that is coming that will make homeownership more affordable. So that is a critical piece of homeownership affordability, and also could be a critical piece in ensuring that we are all becoming part of the solution to create starter homes in California.
Great, thank you. So we have a really active, wonderful webinar audience with lots and lots of questions. A lot of the questions are sort of specific around Cal HFA eligibility for various types of products or income limits and those kinds of questions. I'm going to skip those over, but when we send out our webinar recording, we'll create some links to Cal HFA documentation so that you can get answers to those questions, because there's kind of too many for us to tackle in the next 5 or 6 minutes, and I don't want Ellen to have to be an encyclopedia of program rules. But we're also hearing a little bit about sort of the questions are coming back around this question of sort of geography. So like what's happening in rural areas? How is the insurance issue, particularly in sort of wildfire risk areas, sort of playing out in this equation? What should we be thinking about when we're thinking about where we're building these homes and what kinds of policies are needed? Wondering if one of you or a couple of you want to weigh in on those sort of questions of what works in very different geographic markets in California and what are some of those headwinds?
Again, I'm happy to start, but I'm sure that my co-panelists will have much more to add. So at Cal HFA, what we generally see with our primary programs, and sort of going back many, many years, is that most of our down payment assistance programs work best in the central, more inland areas of California, where home prices are more affordable, and there is inventory that's accessible for folks to buy. That's even despite some of the trends that Dustin's seen, right, about where folks live, that are in the first time home buying market. With the geographic set-asides that we established for Dream for All, we did see some really interesting patterns. So with those geographic set-asides, like that helps us to achieve greater parity, but there's really some nuances about how we implemented it and what we're seeing. We awarded the funds to 9 separate regions based on the percentage of households in each region. But we based the award on where the borrower currently lives. We didn't make any limitation in terms of where that borrower can buy a house. So as long as they meet the income limits in the county in which they ultimately buy a home, they are still eligible to buy a home there. So the outcomes from that policy and that program parameter is really what you would expect. In the lower cost areas like the Capital, Central Valley, Inland Empire, we're seeing folks buy in the region that they currently live. About 95% of people with a Dream for All conditional award are buying in the region that they live in, those regions. In the higher cost regions, in LA County, Orange County, the Bay Area, we're seeing significantly higher levels of outmigration. So about 20% of our awardees in those areas are actually buying a home in a different region. And they're typically buying a home in one of those primary regions that I talked about, where we see most of our home buying activity sort of throughout many years of CalHFA history. So, what that tells us is that affordability, you have to be able to access those affordable units, both in the coastal areas and in the inland areas, if you want true geographic parity in terms of where people can buy homes. Otherwise, the amount of assistance that you would have to provide in order to get folks into some of these really high cost areas like Santa Clara is really just beyond the scale that you could ever hope to implement in a program like this. So I'll stop there, and I'm guessing that Cara and Norena might have more to add.
Well, I was gonna actually just say, like, Norena has talked to me about like some of the cultural differences and where people want to buy, and so I was just gonna ask her to talk about that because I learn from her whenever she does it.
Yeah, I mean, it is absolutely more affordable to buy in the Inland Empire, Central Valley, and in the Capital Region. I mean, I worked with Unidos on a report on Latino homeownership a while back, in the Inland Empire created 82,640 net new Latino homeowners between 2010 and 2021. This was the highest region in the entire country. So really these, and if you go to the Inland Empire, this is where I'm from. If you go to the Inland Empire, you see townhome developments everywhere. So that is, there is development of that starter home in that region. You see that in the Central Valley as well. So that goes hand in hand. The issue is, are we, for home ownership and wealth building, period? I mean, those regions are really critical, but how are we coupling it with infrastructure development? How are we coupling it with a job sector development and opportunities so that people aren't commuting 2 to 3 hours to go to work? So there is an entire economic ecosystem that needs, and in transportation ecosystem that needs to be developed to couple, to ensure that goes with that growth and that opportunity that those areas offer, because there is still growth happening. Homeownership isn't lost in California. Homeownership growth is still happening in those areas, because it's much more it's much more reflective of what people can afford. So that is one issue, but you touched on another issue, Carolina, which is it's insurance, right? That is something that is a huge barrier in we think about it in the context of California, because so many companies are leaving California, so many insurance companies are leaving California, and especially when you see what we just experienced with the LA fires, that crisis has become exacerbated. But this really is a national issue. This is the structure of how the insurance companies are structured right now, their business models. It's not working, and it's something that we all need to work together. And we need to work together with other states. We need to work together. The insurance companies have to be at the table because it needs to make sense for them to make the changes. Government, the insurance companies, everybody needs to come together. And I really commend the National Housing Conference for getting folks together to solve this issue, because I think that's what it's going to take. But that is a huge liability that we all have, and it makes homeownership more unaffordable, to tack on all of the other problems that we have with affordability. But that is definitely something that we need to tackle, and we need to tackle it fast.
Yeah, and also there's no easy answers. So we're coming up at time. I'm going to do one more round of all of you. I'm going to save Dustin for last because I want him to be able to share the very cool dissertation research project he is going to work on, which is going to give us lots of good answers on things. But what's one lesson that you would share maybe to other states or cities or organizations? Like, what would you share to somebody else who really wants to make a difference in their community around these issues, maybe from the vantage point of where you sit? Norena, I'm going to ask you first.
Can you repeat the question one more time, Carolina?
Yeah, like what lesson would you give for other communities, either cities that should really want to spur ADU development or advance it, or maybe even other states that are trying to expand the supply of lower cost homes? Like, what have you learned?
I mean, it's important for us to keep learning, keep working in coalition. We're not starting from scratch. We have very clear lessons learned in terms of what works and what doesn't. So I think this is a lot of the work that Casita Coalition is doing, is ensuring that we're sharing the best practices. We're sharing guidance memos on what are the factors that limit the production of ADUs. We're working with other states as well. We've developed a list of what we call poison pills, or kind of the elements that are included in ADU bills that prevent the production of ADUs. So all my biggest advice is that you're not doing this alone. We've now been doing this for a while. We know what works, we know what doesn't. So it's important for us to work in coalition and ask the questions, and not reinvent the wheel. We know that we need to ensure that there is education to homeowners. We need to, one-stop shops like what San Jose has done is really impactful. And so there are various other strategies that we're seeing that make a difference in terms of, within the state of California and within the country. So we all just got to work in coalition together and reach out to the Casita Coalition, because we have a lot of those guidance memos to offer you.
Wonderful. Ellen? What about other states want to do shared equity? What have you learned? What's the big thing? What's your big lesson?
Well, I'll draw on not just the experience with Dream for All and shared appreciation, but also really CalHFA's experience going back many, many years, leveraging lessons learned back during the great financial crisis. And that is that when we think about these programs, when we think about these innovations and interventions, we do need to really maintain a very crystal clear focus on sustainable homeownership. We don't want to just get folks into homes. We want to make sure that they are able to sustain that home ownership for the long term. And so at CalHFA, and I think this is, what we really need to continue to do, is we need to be looking towards building loan programs that protect the consumer, as Norena said, that educate the consumer, and that make sure folks are really well positioned to not only buy their first home, but to stay in that first home or stay in home ownership for the long term, so that they can benefit from the intergenerational wealth creating effects of home ownership.
Great. Para?
Yeah, I mean, housing is a difficult problem. Like, we're figuring out the insurance issue, and like part of the insurance issue is because the world is changing, and it actually is much harder to insure. Like, I'm not like, oh, I love insurance companies, but like they are in some ways like the canary in the coal mine. And then you have the problem of like yeah, there's not enough housing, but then there's also not enough rentals, and then like homelessness is going up. Like I could just like go blah 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 blah, and it's all interconnected. And if you try to pull one thing out by itself, you'll find it hitched to everything else in the universe. But I think what I really think about a lot now is like how do you eat an elephant one bite at a time? And I think the organizations, the ventures that I see do the best work are really centered on a problem. They're not solutions in search of a problem. They really understand a problem either in their community or that's happening in the system, and they really see it and like have disentangled every part of that little tiny piece and are working on that piece. And I think when you start with a problem, a real problem in your community that you understand, and start like looking for all the resources around you that can help inform that problem, that is when you get really beautiful work in this housing space, and that work that feels actually transformative.
Great. Thank you. That's so inspiring. Dustin, tell us what we're going to learn.
Great, yeah. So all of my co-panelists have been emphasizing the importance of, first trying new things to tackle difficult problems and then systematically learning about them. And so shared appreciation loans, which Ellen's organization, CalHFA, has been offering, are something that housing policy experts and practitioners have been arguing for a long time could make a real difference for first-time homebuyers. There's still a lot that we don't know about how these work. And so I'm really proud to be working with CalHFA and the folks at Turner Center, other folks at Berkeley to get to the bottom of this. And I think what we learned from this study will really help guide housing finance policy moving forward.
Awesome. Well, thank you all. Thank you everybody for attending. We will be sending out this recording as well as all the amazing links that were put into the chat. We'll also make sure that you have links to the Casita Coalition, to CalHFA's Dream for All program guidelines, and then also to Kara's amazing Housing Venture Lab company, so you can learn more about everything that they're doing. So thank you all and have a wonderful rest of your day.